Welcome back to Weekly. Joining me now to chat about China and his book, Red Flags, Why Xi's China is in Jeopardy, is George Magnus, the author. He's joining me from London. Now, last week on the show, we talked about social issues as it relates to China, ideology of President Xi, and how it impacts their technology sector. Tonight, we're going to talk about economics, finance, debt, and the currency. George, thanks for joining me.
Nice to be with you again, Andrew.
So President Xi's made it quite clear that he's worried about the leverage in the system and that he wants to deleverage the economy. But as you point out in your book, there are inconsistencies in what he says about doing that, because he suggests that while he wants to take action to deleverage the financial system, he doesn't want to see any diminution in rates of growth. And he also wants to fix the income gap, the disparity between folks in the country, which is tough to do in what you say is going to undoubtedly be a slowing rate of growth, which is part of a deleveraging situation.
Yeah. And I think this is going to be a really tricky challenge to pull off, really, because the way in which the government rhetoric that we hear it nowadays is that the government really, like most governments, I suppose, they want to have their cake and eat it. So they want to deleverage the financial and the economic system, but at the same time, they don't really want to let growth rates slip. Now, you can't really do this. Not unless the leverage isn't really a very seriously advanced kind of problem, which it is in China's case. So the issue really is the compatibility of maintaining high growth targets, which China still has, and deleveraging the system. In fact, during the course of 2018, we've actually seen this incompatibility become more and more of an issue. So slowly, the government has been backing away, incrementally, I would say, rather than in any kind of wild U-turn of policy. But they have been backing away from some of the more stringent controls. So bank reserve requirements have been reduced, interest rates have come down, banks are being exhorted to lend more to small companies and export companies. So there will be, I think, a bigger kind of stimulus coming out from Beijing, because they don't want to let those economic growth rates slip too far, too fast.
What's that stimulus look like? Is it infrastructure? Is it tax cuts? What is it?
Well, we've already had some measures or initiatives announced to get local governments to spend more money on infrastructure, which is going to happen, I think, this winter. But I think that the most recent issue, I think, is a statement from the Politburo, which basically says that selective measures will be taken to try to shore up or to support economic growth. I think it's very unlikely that China is going to do anything like that huge credit stimulus that they sanctioned back in 2008. That certainly is something I think they will not willingly embrace. But I think fiscal policy, borrowing more money to spend more on tax cuts and on public spending, that's the kind of thing that I would expect to see coming out this winter.
But just drilling a little deeper on stimulus, because of course here in Canada, we sell a lot of commodities to China. So folks are always hoping for stimulus that drives commodity prices. Do you think we're going to see more of that, like additional measures related to that type of stimulus?
Right. So that's the Pavlovian reaction that I think a lot of commodity companies and commodity countries have when China starts, stepping on the stimulus gas, basically. I think that China can stop its economy from sliding, in a serious way for the time being. But I'm not sure that it's going to gain a lot of traction in terms of boosting growth. So I wouldn't get too excited about this right now. I think wait and see.
So how big a debt problem does China have? Because over here, we read about the high domestic savings rate, and therefore, since foreigners don't own a lot of Chinese debt, if the debt's owned locally and the government controls the system, hey, maybe they don't have that big a problem. But you don't see it that way, do you?
Well, No, Andrew. In fact, I think that is it's a nice myth to propagate, but actually it's just not borne out. I mean, it obviously happens more often to emerging countries that have borrowed extensively abroad, that they get, when things go wrong and foreigners withdraw capital, then they obviously have a major problem. Clearly that's not China's situation. But it's not true to say that countries that have a lot of domestic debt don't get into problems. So the United States in 2008 was a domestic debt problem. Japan in the 1980s was a domestic debt problem. America's savings and loan crisis in the 1980s was a domestic debt problem. And China's debt today is also a domestic debt problem. Just because it's domestic doesn't mean to say that, that it doesn't have an issue. Bad debt is bad debt, whichever way you look at it, and it has to be paid for one way or the other, usually through a protracted period of low growth, even if not a major financial crisis. And I don't think China is going to have a Lehman's moment, because no banks will be allowed to go bust. No serious banks anyway. But that doesn't mean to say they haven't got to address the issues of misallocated of lending and resources, which I think they do have to do, and probably sooner rather than later would be my view.